Good afternoon. This is Rob Hoxton, and welcome to HFI's 2015 Kickoff. Our presenter today is Christopher Dorsey. Chris is HFI's portfolio strategist and analyst. He's going to lead us through a review of 2014, which was an interesting year. They always are, of course, and then give you some insight into what we're keeping an eye on in 2015. Our presentation is a little longer than originally advertised. It runs about 40 minutes. It promises to be very informative. I apologize for running you out of your lunch hour, but I think it'll be well worth hanging in there. Any questions are probably best saved and sent to us by email or a telephone call. Our technology limitations are such that taking questions during the webinar totally confuse us. So the presentation is being recorded and will be made available at www.hfiwealth.com in a few days, so you can share that with all your friends and colleagues. But it will be available shortly. And without any other delays, I'm going to hand off to Chris and let him get started. We're glad you're here.
Thank you, Rob, for that introduction, and welcome everyone. I hope everyone had a safe and happy holiday season and that your 2015 is off to a great start. As Rob said, we have a lot of information to get through in a short amount of time, so I'm not going to waste any time, and we'll go ahead and get started. So 2014 was certainly an interesting year. I think we can all agree that one of the biggest surprises of the year was the decline in Treasury yields throughout the year. The overwhelming consensus of analysts and economists going into the year was that we would see a continued increase in Treasury yields throughout the year, as we saw in the latter half of 2013. And of course, that would make it a tough environment for fixed income. You have the inverse relationship between bond yield and bond prices. So if yields increase, bond prices go down. And actually, we saw the opposite of that over the last 12 months. Yields decreased pretty consistently throughout the year, which allowed bond prices to increase. You can see the 10-year U.S. Treasury yield here. It began the year at 3%, fell throughout the year to end at 2.17%. So again, with the declining yields, a pretty good year for fixed income investments. This isn't a trend that we expect to continue over the long term, and I'll touch on that a little later in the presentation. Let's move on to the equity markets. Another interesting piece of the picture in 2014, the S&P 500 or large cap U.S. stocks up 11.4%, so a pretty strong year for large cap U.S. stocks. If you look at the other segments of the U.S. market, performance wasn't as good, and there's actually much less. If you move to international markets, it was actually significantly less than what you saw in the S&P 500. Emerging markets, as you can see here, down about 4.6% on the year. International developed stocks down about 7.4% on the year. You can also see gold down 1.26% for the year. Interestingly, gold was actually up double digits at one point during the year, fell through the second half of the year due to a number of headwinds, and actually ended negative for the year. Some of those headwinds included the increase in the appreciation in the U.S. dollar. We had a strengthening of the U.S. economy, and then also a strong stock market throughout most of the year. So gold being a traditional safe haven investment, you saw a lot of outflows of money through the second half of the year and into riskier assets such as stocks. Again, S&P 500, great year, up 11.4%. Just a few notes on the S&P. It's actually a pretty poor proxy to base investment performance on for the average individual. The S&P 500 is large cap U.S. stocks. The top 5 holdings in the S&P 500 make up 11% of the S&P 500. So just those top 5 stocks out of 500 contributed almost 2.5% of the 11.4% return for the year. So really, unless you were invested in those top 5 companies out of 500 companies, your returns really weren't anywhere close to the 11.4% you see here. And unfortunately, that's what everyone sees on CNBC, on the nightly news, and at the end of the year. That's what they're looking at. But really, not a good proxy to base performance on for the average individual. If you look at small cap U.S. stocks, actually only up about 3.5% for the year. MSCI Japan Index down 5.7% for the year. So you may be aware that Japan's main index was actually up in 2014, but from the perspective of a U.S. investor, because of the appreciation in the U.S. dollar and the depreciation of the yen, the return to a U.S. investor was down almost 5.7%. Europe, one of the most difficult areas in the international market over the last year, down 8.6%. And then if you look at global stocks, aside from the U.S., also down for the year 6.3%. So pretty tough year for the majority of investments, particularly in the international space. Looking at asset classes, the real estate market, one of the only asset classes that was able to outperform large cap U.S. for the year. If you look at commodities, one of the most difficult areas of the market for the year, particularly in energy stocks, we saw oil prices fall over 50% from the highs of the summer. So we'll talk a little bit about that later in the presentation as well. Gold, again, down 1.25% for the year. Bonds were marginally positive for the year. But really, if you look at the performance from the last three slides and consider that a diversified portfolio is a mixture of all of these asset classes and all of these different global markets, you start to see, or it paints the picture why performance for the average diversified investor's portfolio was much less than the S&P would have you believe, probably in the maybe 2, 5, 7% range. Inflation has been in the headlines in the U.S. over the last year. We saw a decline of actually 0.4% in inflation in December. That brought the annualized rate down to just 0.8%. So that's well below the Fed's target of 2% inflation. There's really not too many concerns with inflation being at 0.8% right now. The main contributor, it's no secret, has been the decline in gasoline prices as a result of declining oil prices. And that's really driven the inflation rate down, especially over the last 6 months. So it's not really deflation is not really a concern here, given the reason that the inflation rate has declined. We expect oil prices to recover over the intermediate to long term. Expect to see that inflation number probably start to move back up. On the plus side, the low inflation rate does give the Federal Reserve more flexibility in the timing of their interest rate hike. So low inflation gives them the ability to maybe push that further out into the year. Currently, we're expecting maybe middle of the year, towards the end of the year for the first rate hike. But again, low inflation gives them more flexibility in making that decision. The unemployment rate fell to 5.6% in the United States to end 2014. And that seems good at first look, but if you actually dig into that number a little bit, you see that the labor force participation rate is actually at the lowest level since the 1970s. So yes, unemployment has been coming down, but a lot of that is because more people are giving up looking for a job. And then GDP growth, one of the positive pieces of data in the U.S. over the last 12 months. The final reading on third quarter U.S. GDP was 5%, and that beat expectations. And we actually get fourth quarter GDP estimates tomorrow, January 30th, for the U.S. So hopefully that positive reading we can continue that consistency in positive GDP growth here in the U.S. Looking at a few of your other developed nations internationally, Japan slid into recession in the third quarter of last year. You look at the Eurozone fighting extremely high unemployment. They're struggling with deflationary concerns. So really the U.S. has been the best place to be over the last couple of years. And that's essentially what you're seeing here in this quote on this slide, is that, okay, why has the U.S. been the best relative performer compared to the global market? Well, it's because our data hasn't been great, but it's not terrible, and it's improving. And relative to the global markets, it's really better than what you're seeing globally. So the U.S. remains the best place to be overweight compared to global markets at this time. I wanted to touch a little bit on Fed policy over the last couple of years. The Fed's used some conventional policies. They've also used some unconventional policies since the recession. Some of the more conventional policies have been to effectively raise and lower the interest rates. The way they use that is if the economy is growing too fast, which can result in high inflation, the Fed can raise rates, which reduces the money supply and slows growth in the U.S. We've actually seen the opposite of that since the recession. The economy was growing too slowly, so the Fed lowered rates to expand the money supply, and that has encouraged faster growth in the U.S. economy. Some of the more unconventional policies that the Fed has used include buying mortgage-backed securities, buying longer-dated U.S. Treasury securities. This has been an attempt to, again, increase the money supply, keep interest rates low. Also, the fact that they have been extremely clear and precise in communicating their policy and what they're basing their policy on, that hasn't been typical over the long term, over the history of the Fed, but they've really been careful to very clearly communicate their policy and what they're planning on doing as to try to not upset the market, and that's worked for the most part, especially over the last year or two. I wanted to circle back to the fixed income market. Again, one of the biggest surprises of 2014 was the decline in yields. You can see at the quote on the top of this slide that expectations were for the 10-year yield to increase to 3.4% from 3% where it began the year. That didn't happen. It actually fell to 2.17. Again, we don't expect this trend to continue. The Fed's made it clear that they're likely to increase rates beginning towards the middle or latter part of 2015. Increasing rates will be a headwind for traditional fixed income investments. Increasing rates decrease the price of the bonds. Our recommendation is probably to focus on less interest rate sensitive fixed income securities, maybe shorten your duration for your fixed income assets, look at maybe alternative fixed income assets, floating rate assets which reset as interest rates increase. So you want to pay close attention to your fixed income allocation as rates increase, and again, we expect rates to probably begin to increase this year and certainly over the coming years. So just to touch on a few of the global issues that made headlines over the year. Russia, the situation with Russia and Ukraine certainly occupied the headlines a good bit. That has yet to be resolved. The U.S. and other European nations have imposed pretty stiff sanctions on Europe, which are having an effect. Also, the decline in oil prices is having a significant negative effect on Russia's economy. Russia generates a substantial amount of their country's revenue from oil, so they're really getting hurt on two sides, one with the sanctions, one with low oil prices. ISIS, also in the headlines, an increasing threat globally, not just in the Middle East, but in Europe, in the U.S., so something we'll probably continue to see being dealt with over 2015. And then Ebola virus, we haven't really seen much of that in the headlines recently, but certainly a scare in the first half of the year. It was thought that it was contained within the African borders. That failed to be true. We actually saw it spread to Europe. We had a few cases here in the U.S., one fatal. So again, maybe something that will pop up again in the headlines in 2015. We did have a few bouts of volatility over the last year, but relative to the historical average, really volatility has remained quite low since 2011. If you look at this chart on the next slide, you see the Volatility Index, which essentially is a fear gauge. It measures investors' sentiment and market volatility. And then you have the historical average of about 20 here on the graph. So just looking at 2014, we saw a spike at the beginning of the year, a couple towards the end of the year. But really the theme coming out of 2014 was to buy the dip. Every time volatility increased and equities sold off, it really presented a great buying opportunity as the markets quickly reversed course and moved to new all-time highs after each minor sell-off. On the next slide, we'll look at a longer-term look going back to 2003. Again, you see the Volatility Index, the historical average, and the S&P 500 index. You see a spike in 2008 during the recession in volatility. another spike in 2011. That was when we were dealing with the European crisis, the potential Greek default or Greek exit from the Eurozone. So we saw a spike in 2011. But since then, really we've been below the historical average pretty consistently. A lot of that is attributed to the extremely accommodative policies from the Fed, low rates, monthly asset purchases, and that's really allowed the market to almost be on cruise control, especially since 2012. So now that we've looked at 2014 and some of the major themes, let's now take a look at where we are as we move into 2015. So we've certainly made a substantial amount of progress since the recession. The U.S. economy actually created the most jobs in 2014 than in the last 15 years. We had job production of over 200,000 plus jobs created each month for 11 months straight. So it was a great year in terms of employment. Labor market is improving. This isn't being felt by all of Americans. The more affluent Americans, educated Americans, those that have had investments in the stock market since the recession have improved. Their situations have improved, but there's still many of Americans who have yet to feel that improvement. We touched on the unemployment rate, which has declined to 5.6% at the end of the year. But again, a lot of that is due to people who have stopped looking for a job. Labor force participation at the lowest rate since the 1970s. So while we've improved certainly since the recession, there's still a good ways to go before the benefit is being felt by the entire economy. Here's a graphical representation of the unemployment rate and the labor force participation rate. You see again, since the spike in 2009, unemployment has come down, but so has the number of people who are actually actively looking for a job. So definitely a trend that we want to see reversed over the coming year. Wage growth has gotten particular attention. It's been pretty stagnant here in the U.S. over the last couple of years. If you look at the real average hourly earnings increase in 2014, it was actually just 0.9%. You had an increase of 1.7% in wages, but inflation being at 0.8%. The inflation-adjusted hourly earnings increase was just 0.9%. Ideally, we'd like to see that number back in the 3 to 4% range before we'd really consider conditions to be back where they were. The housing market, data has been somewhat mixed in the housing market over the last couple of years. Home prices have been recovering, but home ownership rates have fallen. The housing market has a lot of room for improvement, and we're pretty excited about housing over the next couple of years given the amount of improvement, the room for improvement that it has. If we start to see steam picking up in the housing market, that could really be a tailwind for U.S. economic growth. That GDP number could shoot up substantially. So we're pretty excited about that area of the market going forward over the next couple of years. One of the things that needs particular attention, mainly from Congress, is the debt level of over $18 trillion and also the deficit. The deficit has come down over the last couple of years. For example, it was at 9.8% of GDP in 2009. This year it's projected to be 2.6% of GDP. But the CBO predicts that there's a lot of issues that we'll face over the next decade. So the next couple of years could be pretty smooth sailing for the deficit, but once you get towards the latter part of the decade, an aging population, rising cost of health care, expansion in federal subsidies for health insurance are expected to substantially boost federal spending on Social Security, government's major health care programs, again, over the next decade. So that's something that Congress needs to tackle now rather than waiting 5 or 10 years before it gets out of control. And the Federal Reserve certainly has helped the stock market and the U.S. economy come back from the recession, but now the Federal Reserve's balance sheet sits at over $4.5 trillion. If you go back to 2007, it was just $870 billion, so almost a 5-fold increase in the size of the Fed's balance sheet. You can see the composition has changed to really incorporate agency mortgage-backed securities and long-term treasury purchases. Those make up the main or the largest pieces of the Fed's balance sheet. The Fed has expressed their intention is to reduce the size of their balance sheet. Janet Yellen, again, as with the tapering of QE, has said that they're going to do this in a very predictable manner so as to not upset the market. It's not likely that the Fed's going to offload trillions of dollars at once. That's highly unlikely because that would, one, put a lot of negative pressure on asset prices. It would cause a spike in interest rates, and it would probably push the U.S. back into recession. So everyone knows that that's not likely to occur. What's more likely to occur is that the Fed, as their securities on their balance sheet mature, they'll just not reinvest the proceeds. So it's a much slower process in terms of reducing the size of their balance sheet, but it also is a very predictable schedule and one that's not likely to really upset the markets. So some countries are winding down their QE programs, the United States for one. The Fed ended its monthly asset purchase program back in October of 2014. It's pledged to keep rates low at least through the middle of this year. Again, the low inflation rate has given the Fed more flexibility in the timing of that first rate increase. On the other side, you have countries who are now just embracing the QE programs. You have China, whose central bank just recently injected $8 billion of capital to support their country's financial markets. You have the European Central Bank, who just recently announced an open-ended 60 billion euro per month bond buying program. So while you have some countries like the U.S. that are winding down, other countries that are slowing, starting to struggle a little more, Japan, Europe, China, you're seeing a lot more assistance from their central banks at this time. So China, you can say, only grew by 7.3% in 2014. That seems great relative to the rest of the country. But China was used to 10+% growth for over 2 decades. They're transitioning their economy to more consumer-driven economy, so we're likely to see that GDP growth number come down, as you see in these estimates by the IMF. But it's a good move for China long-term. Just to touch on oil prices for a minute, we all know oil prices declined over 50% since the summer. There's a couple of reasons why that occurred. One is supply. Global supply is up substantially, mainly as a result of U.S. production surging over the last couple of years. Demand, while it's still increasing, has slowed. Slowdowns in Europe, slowdowns in China are affecting and raising concerns over demand going forward. And then also OPEC, the Organization of Petroleum Exporting Countries, at their latest meeting last year decided to maintain their current level of production, and really that sent prices in a downward spiral. There's a lot of posturing going on. The current level of oil prices is not sustainable for the majority, if not all, of OPEC countries, and really we would expect to see a production cut at some point this year. And really Saudi Arabia in particular is trying to drive out some of the newer U.S. players to get the U.S. to curb their production. So we'll see what happens, but we would certainly expect over the long term oil prices to rebound by a pretty large amount. And just again to touch on, the United States has been surging in terms of oil production over the last couple of years. They are now the largest producer of oil in the world, overtaking Saudi Arabia and Russia. So again, that's where that huge increase in supply has occurred over the last couple of years. As with anything, there's countries who benefit from certain situations and those that are hurt by certain situations. If we're looking at oil, net exporters of oil are hurt by the low prices because they're receiving less revenues. The countries that are net importers of oil actually benefit because it's cheaper for them to import oil. Looking at a couple of those who benefit, the U.S., it's somewhat mixed. The U.S. is the biggest producer, consumer, and importer of oil, so really we don't know what the effect will be here. On the positive note in the U.S., you do have a significant decline in gasoline prices, which adds discretionary income to the consumer, and that could really be a boost for the U.S. economy over the next year. China, second largest importer of oil, they save over $2 billion a year for every dollar decline in oil, so China certainly benefits. Europe, again, not really sure. Their energy bill will be smaller, but deflationary concerns are going to increase, so probably the net effect is something more negative for Europe. India, one of the biggest winners, 1/3 of their imports are oil, so not only a benefit from that aspect, but also cheaper energy moderates inflation, helps the country to deal with its budget deficit. So India, one of the biggest benefactors of low oil prices. Saudi Arabia has come out over the last several months and said that they're fine with oil prices where they are. They could withstand oil prices even going slightly lower. Really, that's somewhat of posturing, as I said earlier. Their price for oil in order to break even on their fiscal budget is much higher than oil prices are now. They have enough reserves, though, that it allows them to weather an environment, at least in the near term, of low oil prices. But over the long term, they definitely need oil prices higher than where they are now. Venezuela, one of the OPEC countries getting hurt the most, they need $120 a barrel oil to finance their spending needs. Obviously, we're much less than that at this point, and they've voiced their concerns several times over the last couple of months, in particular to Saudi Arabia, saying that, hey, OPEC needs to cut production. So, again, their oil prices may be volatile in the near term, but certainly I would expect at least some production cut by OPEC at some point this year. Iran, you can see, needs $136 a barrel to finance its spending needs. Russia is a non-OPEC member country, but they generate a significant amount of their country's revenues from oil. So they're getting slammed. Their economy is getting slammed by low oil prices. Recession is an issue there. And also you have the sanctions on top of low oil prices. So Russia is really one of the biggest losers in this situation. So now let's take a look at some of the things to look for over the course of 2015. Here's just a snapshot of some of the GDP estimates for your different countries. The U.S. at 2.6%, United Kingdom at 2.4%. Again, China at 6.5%, which is great relative to the rest of the world, but a lot slower than they're used to. And then on the other end, you have Russia, again, one of the most difficult areas of the world market at this point, 0.8% GDP growth estimate. Japan just 1.1%. So what's one of the biggest threats to U.S. economic growth this year? Well, predictions are the biggest threat is a negative global event. So what does that look like? What are they talking about there? Well, the Eurozone, of course, is struggling. Their economic data has been very poor. They're fighting to keep their heads above water. They're fighting with deflationary concerns. So depending on how that situation plays out, if it gets worse, if it gets better, that could have an impact on international countries. We saw international markets do pretty poor last year, and this is one of the things that could determine whether there's a rebound this year or not. If you look at the Greek elections, the anti-austerity party just won in the most recent elections, so now that's renewed concerns of a potential Greek exit from the Eurozone. So there's always some issue in Europe, and we'll see if things can improve over the next year there. The decline in oil prices and commodity prices in general, again, hurts some countries, helps other countries. The emerging market countries that, again, are net exporters of oil are going to be affected much more negatively than a lot of your other countries. So it's somewhat of a mixed effect in terms of emerging markets. What the net impact will be on that space in terms of market performance is yet to be seen. Again, it helps some of those countries like India that are net importers of oil. So emerging markets really has been a relative underperformer relative to the rest of the world over the last couple of years. So will 2015 be the year when emerging markets come back? We'll see. Oil prices are probably going to have a big impact on that, on whether or not that happens. And then China, again, 6.5% expected growth, still good relative to the rest of the world, but slow for China. And China, just because of the size of their economy and their impact on the global economy, whatever happens there is likely to have at least a small impact on the rest of the world markets. If there's better than expected growth, we'll probably see that as a tailwind. Worse than expected growth, probably a headwind for economic growth, mainly on the international side. And then not necessarily something that could upset the markets, but certainly one thing that investors are interested in seeing is the timing of the Fed's first rate hike. Predictions are, again, right now that it's probably looking like the middle to the end of the year before interest rates are raised by the Fed, but definitely something to watch. And I would bet that Janet Yellen and the Fed are going to be very clear in what they're basing that decision on, so it won't come as any surprise. Probably will have limited impact on the U.S. market. A few things that we're excited about, a few things that may actually be a significant tailwind for economic growth in the markets this year. Lower gas prices is certainly one of the main things. That's more money in the pocket of the consumer. Consumer spending makes up over 2/3 of U.S. GDP, so if we see a pickup in consumer spending, that could really drive economic growth higher than expectations this year. Housing market, again, you see here, really excited about the housing market. If we start to see steam building in the housing market, there's a lot of room for improvement there. That could really be a strong tailwind for the U.S. markets. And then if economic data picks up, hiring picks up, job growth continues to be positive, that could lead to better wages, which again is one of the really annoying parts of the labor market at this point is the stagnant wage growth. So a pickup there would really be a boost to U.S. economic growth. Wall Street consensus is for a continued bull market increase in the stock market in 2015. 10% is the average estimate going into the next year. Some are more, some are less, but the takeaway here is that the majority of analysts expect the U.S. market to remain favored into the next year. Just to touch on earnings for a second, strategists see the S&P 500 earnings rising 7.5%. We know earnings have been increasing substantially since the recession. Corporate profits are at all-time highs. If this continues, likely to see the U.S. market continue to do well. Opportunities. If you're looking from a pure valuation standpoint, yeah, international markets and emerging markets look good. The U.S. has done much better. International markets have been beat down, especially last year. So just looking at valuation, it looks like there's an opportunity there. However, we tend to stay focused on the U.S. market. We think relative performance is likely to continue at least over the next year. Here in the U.S., again, given global uncertainty, the U.S. market data is improving. There's a lot of potential headwinds over the next year that could boost U.S. economic growth and boost the stock market. So that's really where we're focusing, and that's where we expect to see relative outperformance over 2015. So I know we ran a little long, but I want to thank you all for taking some time out of your day to join us. At HFI here, we're really excited about 2015. We think there's a lot of opportunities. We think we're positioned to take advantage of those opportunities. And as I'll pass it back to Rob for some closing remarks. But if you have any questions, feel free to reach out to me or Rob. And again, thank you for being here.
Chris, thank you very much. You know, the thing that just strikes me is that even as things unfold around the world and the economic information becomes more clear, having a strategy, having a diversified portfolio is prudent. Prudent for all investors. I'm excited about, as you are, Chris, some of the opportunities that appear to be presenting themselves, and look forward to working for everyone. We appreciate the turnout. We had a terrific turnout, and while we can tell that some folks were taking a nap, most of you were real attentive, and just really I hope that it's been good. You can see the email addresses in front of you and the phone number. Please give us a call or shoot us an email and let us know if there are questions that we can answer for you. It's been great being with you today. We wish you the best.